What is your biggest risk when it comes to policy missteps or the way that the inflation mindset may have already been entrenched going into the second half?
Well, I guess the biggest risk in terms of markets, obviously relates to inflation, but that can really, and the risk of recession. But to me, the biggest risk is how much central banks have to hike rates by in order to get inflation back under control. I mean, the optimist in me tells me that we will start to see some relief over the next 6 to 9 months on the inflation front. We are seeing demand slow down. We're seeing supply bottlenecks start to improve to some degree, and that should provide some relief later this year, allowing the central banks to ease up. By easing up, I mean just raise rates at a slower rate eventually. But the risk is that this goes on for longer and central banks do end up going over that line that tips their economies into recession. So I think that's the big one for investors to watch. But the trouble is we won't know which way it goes for several months yet, probably not until around September, October at the earliest.
Right. So in the meantime, you've got the inflation mindset, the recession mindset is getting stronger. There's concerns about these, supersized hikes, for example, here for the RBA really weighing into how the consumer responds. Does that mean you're hedging against some of those consumer stocks, for example, in your investing strategy?
Well, you have to in this environment. You have to be somewhat cautious. I think if you take a 12-month view or a 10-year view, you could probably put it all behind you and not worry about it too much. But by the same token, there is significant downside risk still in the short term on the inflation front. And those rate hikes have become more aggressive. In some ways, that's good news. This pivot by central banks in the last 4 to 6 weeks, you could argue is good news because the central banks finally started to take the problem very seriously. And I think that averts to some degree the risk that inflation expectations get out of control and we have a rerun of the 1970s where inflation spent 10 to 15 years, way above where it should have been. So that gives me a little bit of confidence in the longer term, but it does bring this short-term risk of recession. You could argue perhaps that given what happened in the 1970s, if you're an investor, you should be cheering central banks on because if they get inflation under control earlier rather than let inflation expectations take hold at higher levels, that will lead to an even worse outcome for share markets than say, a recession in the short term would.
Shane, David here. We had a very big rally in the bond markets last week. If recession is a concern, certainly they're telling us that. You look at equity markets, the earnings projections have yet to really start trending lower globally. I'm just wondering, how does this inform you where equity markets go? Are they cheap enough? Have they bottomed equity markets?
It's a good question. I mean, if you look at the US share market, top to bottom, it's had a fall of nearly 24%. Global shares, I think, around 21% if you measure it in local currency terms. So you could argue that they're sort of on the cusp of factoring in a lot of bad news in terms of recession already, although historically with significant recessions like the GFC, you'd probably have another big leg down in markets. But by the same token, you could argue that the bulk of the decline in share markets so far has been, simply going back to your point about earnings, has simply been on valuations. PEs have come down as bond yields have gone up. So it's been a valuation adjustment. So if we are going to see more earnings, or if we are going to see a recession, then that means we get more earnings downgrades going forward. And that line you had up there just then will start to turn down. And historically, share markets have fallen through the first part of that. So once you start to see the earnings downgrades, it's usually, 3 to 4 months before share markets finally make a bottom.
The big swing factor that some have flagged is the recovery in the Chinese economy. Do you think, Shane, that's net inflationary, i.e., there's not a lot, enough commodity in the world right now to essentially provide for a Chinese recovery, or is that net deflationary because some of the supply chain kinks get sort of smoothened out?
Yeah, that's a really difficult one to work out, and that's why we've got people on either side of the argument on that particular issue. I'd have to say it's more of a positive than a negative, mainly maybe because I'm sitting here in Australia, which is a commodity exporter, and it will benefit from increased commodity demand. But in a net sense, I'd rather see the Chinese economy recover. That would probably be good for global growth, and ultimately, I have to say, yeah, it's probably going to be more of a positive for supply chain disruptions. Yes, there will be upwards pressure on commodity prices from that, but I doubt that it's going to take commodity prices to a new high, at least not in the next 12 months.
What is the balance of risk for the RBA this week? Because we've already talked about the sort of fragility of the Australian consumer, the implications for the property market, but how much, I guess, space will they have if we actually, for some reason, actually see energy prices on the supply side start to come down in the second half?
Well, that's why the Reserve Bank has to tread carefully here. I think they are right to go hard and go fast up front because there is a risk that inflation expectations rise if they don't. So they're really underlining their commitment to their 2 to 3% inflation target. If they don't do that, then I think we'll end up with a far worse outcome. But they also have to be prepared to slow up, I think, fairly quickly. We are seeing clear evidence that house prices are falling. Of course, the Reserve Bank would say, well, they rose 30%, so it's just a flick off the top. But that decline in house prices looks to be gathering steam. More importantly, we've got very low levels of consumer confidence in Australia, and I think it's only a matter of time before that feeds through to lower spending in Australia. And that tells me that you're seeing a response, at least in housing and in consumer, which is a lot earlier in this rate tightening cycle than we have seen in the past, which means the Reserve Bank, I think, won't have to continue aggressively raising rates right through the end of this year, won't be raising rates to 3% plus that the money market's talking about, and probably will be able to top out the cash rate at around 2.5%, hopefully on a worst case basis, in the first half of next year.